4 is what I am teaching, that is organization theory. So there are 4 courses.
Yes, Captain.
Now what we have done on past student feedback is that marketing management and OT, which happened yesterday,
yes,
are
Captain.
combined classes.
Yes, yes,
Okay.
combined. Yes,
so there is
Captain.
no section A and section B.
Yes, Captain.
Courses on accounting and human resource management,
yes,
because they were deemed to be tougher, have been split into smaller cohorts, that is section A and section B.
Okay.
All of you may determine that enough of emails have been sent by Professor Rajan. So all of you may please check which section you are in and join that particular section.
Sure,
Okay,
Captain.
because otherwise what will happen is that you may be attending the wrong class.
Yes.
With respect to accounting and human resource management.
Okay.
Beyond this, there is something called as a group.
Okay, yes.
The group is meant only for assignments.
Okay.
Okay, so for example, I have put up my assignment 2 and assignment 1. Assignment 1 is an individual assignment.
Yes.
Assignment 2 is a group assignment.
Yes, Captain.
So you all need to be in a group to attend assignment 2.
Okay.
Now so groups may cut across sections.
Okay. Yes.
Okay, for my subject and for marketing management and so on and so forth, right?
Yes, Captain.
So please identify which group you folk are in and pursue it.
Okay, sure, Captain.
Understood, sir.
The problem is people don't spend time either on reading emails or following what is the course, get an overall picture of the course architecture, of the program architecture, the number of courses, what you are doing, why are you doing, why should you be doing, answer all these questions clearly for yourself, spend about 2 hours. Yeah?
Yes,
all the questions will disappear. It is not rocket science.
Okay, sir. Even we all were confused just by the division of the section and what classes we are supposed to attend. So now it is clear.
Now you know which section you are in?
Yes, sir.
Yes,
Please
Captain.
follow that section class.
Yes, Captain.
The links are different for both the classes.
Sir, to confirm, so sections are for done for particular classes, and
sections are done for particular courses.
Yes, particular courses, and combined is also for particular courses. Which courses are into combined? So
there are 2 combination courses, that is marketing management and OT. There are 2 split courses, that is human resource management and accounting, which are happening today.
Yes, sir. So basically, these links, 2 links are basically based on the combined and separate courses.
100% correct.
Yes, it's to understand clearly.
No, you understood. I think you understood.
Yes, sir.
I think
we all understood.
It's logical. There is no confusion. Yeah, there is no need to panic. We are not going to on the Mangalyaan mission or something like that. It's a fairly simple, straightforward academic program. Yeah, there are only 4 courses. Just imagine if we had 15 courses going. Yeah, so the point is spend some time in thinking about this. It will all dawn. But if you just keep quiet and keep asking questions to everybody and then cause confusion on that sad WhatsApp group, we're going to get more confused. So are you all in the right section?
No, Captain. I am from B section. I will leave now.
Please
thank you, Captain.
Please leave and go and join your correct class.
Yes, Captain. Thank you. Thank you very much.
So this is a class for A section, is it?
Yes, sir.
If any of you belong to B section, please, exit pronto and go to your other class, which is, I assume, human resource management. Yeah. Now this is accounting for managers, correct? So you're going to human resource management. So are there any other doubts? For the moment, no.
No, not for this class, sir.
Also, I put up assignment 1 and assignment 2. Assignment 2 is tougher than assignment 1. So please stay connected with your group mates. And then if you are having any problems, please reach back to me. Yeah.
Sure, sir.
Sure, sir. Sure, sir. So, sir, Sushma here. Sir, yesterday's class was combined for both, right? I mean, A and B.
Correct.
Okay.
Yesterday's class.
Yeah, I think this trimester one schedule in the PDF that is clear now. In the PDF also it is mentioned when it is combined and when it is not combined.
Correct. Everything is mentioned very clearly.
Yeah.
Please spend time in
Yes,
perusing it closely. Dr. Gopal Krishnan, are you there by any chance? Dr. Muthu? Was he there? Yeah, it's not there. But Dr. Gopal Krishnan?
No, that host. Who is the host? Yes, you know.
Who is the professor here? Folks, just hold on for a minute. Huh? Dr. Muthu, are you there?
Sir, good morning, sir.
Good morning,
Dr.
sir.
I'm here.
Yeah, okay, good. So, all set to go for your class, right?
Yeah. Yes, sir. I'm ready.
Yeah, thank you. Thank you.
Thank you, sir. Can I start, sir?
Please. All students are waiting, I think. Yeah.
Thank you. Okay. Good morning to all of you. I'm Dr. Muthu. I'm just going to take you through this course called Accounting for Managers. First of all, I welcome all of you to EMBA of the Anand Sagar College University, and particularly to this course called Accounting for Managers. Okay. So to begin with, I would like to give you the course outline in the beginning. Then from there we can move on. Okay, I have been teaching this course for 2 decades. So accounting for managers. Okay, so this course is consisting of 5 modules for us in our course outline. First one is about introduction. Okay, in which we are going to learn about the basic concepts of accounting and how the basic accounting mechanism works. Okay, how the accounting department is organized in a company or a business unit, and how the transactions are recorded. Okay, and then moving on, Second unit, we have accounting standards. You know very well, for every activity, for every exercise, what you do, we have to have certain kind of rules and regulations, certain framework, certain things which guide us to do that activity. So likewise, here also, to record the business transactions, we do have certain rules and regulations. Of course, the rules and regulations evolved over a period of time from the accountant of various country. That is separate, that we are learning in the first unit. The second unit, when you call about accounting standards, the rules and regulations told by the accounting bodies. The accounting bodies. If you take in India, we have Institute of Chartered Accountant of India. Likewise, each and every country will have its own accounting bodies, professional accounting bodies. They will just propound, they will just notify the different rules and regulations to be followed in that country with regard to maintaining of books of accounts, with regard to preparation of financial statements. Okay, so those things we call it as accounting standards. So that we are going to discuss in the unit number 2. Okay, so the third unit is mainly company final accounts. Actually, the purpose of accounting is being achieved in this particular unit called accounting for final accounts of companies. Really, the company has done good or not, what is the company's financial position on a particular day, okay, how much the company has earned as profit, or how much the company has suffered as loss. All those things, the result of the business is being captured in one particular mechanism that is called final accounts, or I can say financial statements. Okay, please understand, final accounts and financial statements, both are one and the same. So we are going to prepare, and we are going to understand how to read and how to prepare the financial statements of a company. Okay, of a company, that is being taught in third module. Then fourth module is very important module for MBA graduates and executives, analyzing such statements, what we prepared in unit number 3. Okay, that's a job of purely an accountant. As an executive, I should be able to read that financial statement. If I get to know any financial statement, I should be reading and understanding. Reading, I mean, of course, everybody literate can read the sentence given over there, but with accounting knowledge, what exactly that figure means, what exactly that item means in that financial statement. So reading. Then after reading that, I have to analyze such data found in the financial statements, and I have to draw some meaningful conclusion, logical conclusion, in order to help the management to take any future managerial decisions. So for that, we have to analyze the financial statements. Such techniques, such methods are tools which are helpful for analyzing and interpreting the financial statements. We are going to learn in the fourth module, right? Then the last and fifth module is about cost accounting. If you say accounting for managers, it includes 3 academic names of the accounting. One is financial accounting, another one is management accounting, the last one is cost accounting. So we are going to learn something on how do we determine the cost of a product, how do we have how can we determine the number of units to be sold to reach out a break-even point. We might have heard about this in general, break-even. Before you start any business for that matter, or any new product introduction in the business, we just analyze what is the break-even. If I spend this much on producing a product A, how much I have to sell to get back that money what I spent. So break-even point. So all these things we are going to discuss in the last unit called cost accounting. So I can say you are going to learn this particular subject from the perspective of managerial aspects. How the accounting data are captured in the accounting system, and how it is displayed and how it is communicated to the needy people. From that data, what as a manager, what as an analyst, what as an executive can draw some meaningful information or meaningful interpretation to draw a logical conclusion. So based on that aspect, okay, we are not going to work as an accountant. Okay, after studying this course, you are not going to be an accountant. Okay, but fairly we can make you as an analyst to read the financial statement to fairly good manner and to understand what is the data given over there in the financial statement and how do I analyze that statement or the data and what for that analysis is for and how can I achieve some objective of making some decision. So this, with this respect, we are going to approach this subject. Okay. So we have 5 modules. So we can go one by one now. Accounting for manager. The first module is Introduction to Accounting. Okay. Before we go on to discuss this in detail,
Sir,
yeah, somebody wants to say something?
Yeah, if you come close to the mic, sir.
Okay, I'm not audible to you. Yeah.
Now it is better, sir.
Let me check. Yeah, I'm now closer to the mic and I have increased the volume also. Yeah, okay. So we have 5 modules. One is Introduction to Accounting. Second one is Accounting Standards. Third one is Preparation of Financial Statements. Fourth one is Analyzing the Financial Statements. Last one is Orientation to Cost Accounting. Orientation to Cost Accounting. Okay. I assume that most of you or many of you may be from the different background, mostly from engineering background or science background. Maybe the concept, the subject called accounting may be new to your stage to you. Okay. Keeping that in mind, I'll just take you through the basic concepts. I hope few of you may be already knowing about this basic accounting rules and regulations and other framework and aspects like that. So I have to go with a balanced way. So those who are already knowing, please bear with me if I say anything which is known to you already. Okay. And those who are new to accounting, if you feel that a concept is very much new to you or you are getting some not much clarity, please stop me and you ask, then we can go further. Okay. That is the understanding. We will just move ahead. Okay. So these are the various aspects we are going to study in this first module called Introduction to Accounting. Okay. Before we start accounting class, let me ask a few questions to you, 1 or 2 questions to you. Suppose, what is business? It's very basic. I don't think that what sir is asking very basic question or it is already known to us. Anyone can respond. What is a business? According to you, what do you mean by the term business?
Where there is a transaction.
What is that?
Where there is a transaction.
Okay, there is a transaction. Okay.
Where the goods or services are, sold within the rules and regulations of the organization or country, and to earn the profit.
Okay, to earn the profit. Okay, somebody raised their hand. You are only talking or somebody else? Somebody, you can unmute yourself and you can.
Wherever we have that money transaction like credit and debit, so that is the business. I am Dhananjay, sir.
So many people are there without knowing debit and credit also. No, they are doing business. Where do you bring? You are a BCom student. You are bringing immediately the debit and credit into the picture. Okay, fine. There are transactions. You are telling that there are transactions, right? Yeah.
Business means state of being busy. State of being busy.
Oh, state of being busy. A good and easy definition. It has its own meaning. A state of being busy. Okay, busyness. Okay, business. Okay, right.
It's all about the profit and loss, Ritesh here.
Sorry, sir.
It's all about profit and loss.
It's all about profit and loss. Okay. Yeah.
Sir, it's all about sales and purchase.
It's all about sales and purchase. Okay. So you are all connecting business with the broadly keeping in mind the finance or the accounting in mind, and you are trying to figure out what is business. But I really like that definition what the other gentleman was telling. The state of being business. Okay. State of being busy. Okay, right. So having said and done, all these things are correct. Whatever you told is correct. So bring all those things in a single sentence. Now, organized economic activity which is trying to achieve a financial goal of reaching out a profit. Okay, I want to do something. I want to be busy with something You told purchase and sales, debit and credit, and so many things you told. Everything put together. I want to be busy with doing something. The objective of doing something, doing that thing, is to generate, more money than what I invested. Can you catch me? So I am just doing something. I'm just being busy in doing something in an organized way, so that I can I can generate more money in the way of profit. Okay. If you say business is an organized economic activity, the business can be of three types in general. You take any business for that matter. You may be working in many of the companies. You are always in the company and you are doing, you are aiding, or you are in the process of delivering a business. Okay, you may be an engineer, or you may be a customer care officer, or so many positions you may be already occupying. Okay, what I'm trying to say is we are doing any business, but any kind of such businesses will be coming under any three category. What I'm going to tell you now, very basic. You can buy raw material, you can produce something, and you can sell. These are manufacturing businesses. Okay, car manufacturer, pharma manufacturer, okay, tire manufacturer. There are manufacturing businesses. Another one is I don't produce anything. I don't want to produce anything. Okay, I just buy from the manufacturer. I just stock it. I just sell it to the needy people. It can be a retailer, or it can be another wholesaler, or it can be an end consumer. Am I right? So one is a manufacturing business, and another one is trading business or merchandising business. But I would like you to understand this concept very clearly. Manufacturing, I just buy material, I assemble it, I apply some technology over there, I convert that material into a finished product, and I sell it to somebody. That kind of business units can be called as manufacturing businesses. The another category is
Trading
I don't know
business.
any. Sorry?
Nothing, sir.
Yeah, I don't have any technology and I don't have any intention to manufacture anything. Just I would like to act as an intermediary between the buyer and the manufacturer. Okay, so the business what I do, connecting the manufacturer and the buyer, is called trading business, or I can call it as merchandising business. Merchandising. Okay, there are many companies. They don't manufacture anything. They just buy from the manufacturer. They just sell it. Okay, you can take the example of the supermarket. They just don't manufacture anything. They just buy from the various brands and just they sell it out. Okay, it's called trading or merchandising business. The third category. Can anyone tell me what is the third category? Maybe
Services.
service industry, service businesses. They neither manufacture nor sell anything, but they just render service to the customers. They just render service to the customer. Bank, insurance companies, okay, and so on. Okay, so first, as a student of business, as a student of finance, to be very specific, as a student of accounting, you should know the broad category, the broad classification of the nature of business. Nature. Okay, one is manufacturing business, another one is trading business, another one is service business. But for my understanding, for academic understanding, we have these three. But there may be a situation, one company may do any of these two together, or three of these together, or only one. Okay, that is left to them. Okay, some companies will have two activities together. Okay, they render service as well, and they will also have a manufacturing unit. Okay, okay. Next, we have to understand the ownership of a business. Ownership. First, we have discussed about what is business. Then we discussed about the nature of business. Now we are discussing about the ownership pattern of a business. Suppose if you want to start a business, we need money. One who contributes money to the business can be a owner. One who is taking risk. Sir, I have a business idea. I want to start it. I have money. Okay, or I am just taking money from outside. So based on the contribution of money to the business, the ownership pattern of the business is being decided. Okay, anybody can tell me what are the different ownership of a business organizations are there?
Proprietorship, partnership,
Yeah, proprietorship, partnership,
stakeholder,
company,
that is a
sole owner,
shareholder.
no. Look at the word proprietorship. If he is telling proprietor, that can be equated to the shareholder. Proprietorship is nothing but, it's not a person. That it's referring to a state of affair. Proprietorship. So first one is proprietorship. Second one is
partnership,
partnership. Proprietorship, for the benefit of others who do not know business from your 11th standard or from the degree, only single person, you only contribute the entire money to your business and you do the business. You can employ anybody for that matter for carrying out the business. You can employ, but you are the only owner. The entire money is contributed by you. If you lack in some kind of finance, you take it from a bank or you take it from business, another friend as a loan. Please look at the difference. The owner contributes money, that is in accounting or in business we call it as capital. The capital, or simply broader sense investment. How much I invest? Suppose I have invested 50 lakhs, but the business needs another 25 lakhs. I can take it from you as a loan. As a loan, you are a lender to my business. Whatever is happening in the business, you don't have any kind of problem. You mind about your interest, the rate at which I agreed upon, and the money repayment. That's all. You don't worry about the loss or profit or the way in which the business is run. You don't have any say on that. Okay, that is called proprietorship or sole trading business organization. Sole trading business organization or proprietorship business organization. Only single owner, whatever the profit or loss, it is going to be taken by that owner himself. He can take from others the money, but that money is taken in the form of loan. Okay, and then the work, he can take it from others by paying salary. He need not be working alone. It does not mean that. Okay, he can take anybody as a employee. He can hire employees. Okay, that is proprietorship. Okay, second one, somebody told partnership. More than one owners are going to be there. I myself, you as my friend, or another two members, four of us are joining together. We contribute money to the business. We contribute. So all the money what we contribute is the total capital of the business. In spite of that contribution, still the business needs some money, you can borrow. That's just like another sole proprietorship, you can borrow. But the profit or loss earned by this business can be shared by these people, partnership. So that second type of ownership is partnership. The third type of ownership is Hindu undivided family. Please don't confuse the word family business and this form of business organization. Family business need not to be a Hindu undivided family. Then what is a Hindu undivided family? There's an ancestral property, ancestral business. Okay. The family is a Hindu family and it is not divided its property, its business. The co-partners are the co-owners of the business and they are doing the business as a collective business. Hindu undivided family. Okay. Suppose I am an Hindu. Okay, I have a business. All my family members are looking after this business, but I cannot simply, for the sake of calling it as HUF, I cannot call it as. Okay, I should have an ancestral property. That ancestral property should be in a business, and I should have not divided my property among the co-partners. Okay, the fellow partners. Okay, they should have a business. This is called Hindu undivided family. That's another form of ownership.
So here one doubt.
So one.
HUF, you said that it should be ancestors' business and it should not be divided. But must that the same business has to be carried from the?
It need not to be. Need not to be. You can change the business. You can change the business, but the problem, what I want to make it point is, as just you are an Hindu and you are having a family business, that cannot be called as Hindu undivided family business, HUF model of business. Okay. Your karta, I mean the grandfather or father, before that, the ancestral property should come and there should not have been any partition of property. And there should be a business. All these three conditions should be satisfied. You should be an Hindu and you should have an undivided property and you should have a business. Just merely having a business by an Hindu family cannot be called as HUF. Just I want to start a business. I can start either in partnership form, or I can start in the form of sole proprietorship as well. Okay, I cannot just start a business under HUF because I don't have ancestral property. I don't have a business coming in. Okay, inherited property and inherited business coming in. Okay, it's very very less number of units are there in this kind of ownership. Okay, right. The third one, fourth one is
Sir, one, sir, is your that PPT is the PPT is changing? I'm not saying the PPT is changing.
I'm just in the first line, the language of business,
okay,
and explain the concept of business only. It's not changing. I'm not changing it. Okay.
Okay.
Yeah. So the fourth form of business organization is cooperative form of business organization. Cooperative form. Okay. I'm just an artisan or a weaver, or I am just knowing some kind of business. As my business to develop, I just take my fellow friends who is there in the same business for the benefit of everybody. I just form a cooperative form of organization and I do the business. Mainly weavers and village level artisans and these carpenters, or maybe even in a college or university cooperative student cooperative stores will be there. So this kind of form of ownership is called cooperative form of business organizations. The last one, the fifth one, very important one, and whatever we are seeing in our life, okay, and which gives more life to the profession of accounting, is joint stock company form of organization. Joint stock, or simply in your modern term, you will just say company form of organization. Company form of organization. What does it mean? Here only somebody told in the beginning shareholder. Okay, n number of people who knows or not knowing with each other, joining together, and they just form and run a business. That business is called as joint stock company form of ownership business. Example, Reliance Industry Limited, HDFC Limited, ICICI Limited, Apollo Tire Limited. Like that, we have the limited liability companies, right? Those type of organizations, I mean joint stock companies. What is the specialty about it? What is the goodness about it? N number of owners can join. Number of owners, there is no limit. Anybody can join. If you subscribe the shares of that company, you are also a part owner of that company. Okay. So resources are mobilized from the globe, entire globe. Anybody can, depending upon the rules and regulations of that land of the particular company, you can just contribute your money as a shareholder. So shareholders are there only in joint stock companies. Okay. So accounting is a language of business. When you understand accounting is a language of business, you should know what business you are referring to. In reality, these three type of businesses are there in these any one of the five form of business organizations. There may be a service company, there may be a service unit which is in the form of sole proprietorship, or which may be in the form of joint stock company. We as a student of accounting for manager are going to concentrate more on the last form of business organization, that is joint stock company form of business organization. Because in today's world, joint stock companies are more in number and they have more caliber to do more businesses. Okay, and you and me, everybody, most of us are working in joint stock company form of organization, and it has one feature, that is ownership is separated from the management. Suppose you say HDFC Limited. I may be having a share of HDFC Limited, but I do not manage the company directly. Likewise, you also. The owners are scattered throughout the world. Owner means the shareholders are scattered throughout the world, but on behalf of the shareholders, they appoint a board of directors to manage the business. So in that way, I say management is diverged from, separated from the owners. If that is the case, managers are delivering their duties in fullest interest of the owners are not need to be checked. I hope you are understanding. If I myself do the business, or I myself overseeing my business every day in a day-to-day life, day-to-day activities, it is easy. There is no need of appointing somebody to manage or monitor or ensure the business is going on in the fullest interest of mine. But In the case of company, the head office of the company or the registered office of the company or the business unit of the company can be in the remote corner, can be in some of the places. But the owners are scattered throughout the world. Simple example, you and me are in Bangalore, business unit may be in Mumbai, I am the shareholder of that business, but I do not know what is happening in the business. So on behalf of all shareholders, we elect a board of directors. They will just monitor the business. They will just carry out the business on behalf of all the shareholders. So there arises a need whether the business is carried out to the fullest interest of the owners of the business, the shareholders. The purpose for which I joined the business is being achieved or not need to be checked every now and then. The single, even a penny amount, I mean every rupee or every paisa, whatever I have given to the business is used for the purpose for which I have given or not, is to be checked and it need to be assured to me as a shareholder. For that, we need this accounting profession to be there, and they just monitor, they just ensure, they just make sure that it is done according to the rules and regulations. For that, the accounting profession becomes very important. Okay, so accounting is the language of business. We have to be very careful about what business is and what form of ownership. Then only we can understand or we can use that kind of language. So what I mean that each and every business type and each and every business ownership will have a differences, will have some differences in recording transactions, in carrying out the accounting entries or something like that. But overall, the accounting remains, the basic rule remains the same, but here and there some changes will be there depending upon the nature of business and depending upon the ownership of the business. Yes, somebody is raising hand, please. Yes. Yeah. Yes?
No doubt, sir. Clear,
okay.
sir.
By mistake. Okay, fine.
Sir, this is Gopal. I just wanted you to brief us something about private limited company and a limited liability partnership. I think that's one of the kind of ownership.
Sorry for asking a very good question. It's simple. Anybody would like to answer? There are three concepts here. One of the types of partnership is LLP, limited liability partnership, and one of the types of joint stock companies is private limited company, and another one is public limited company. Okay, please understand. LLP is the type of one of the types of partnership. The second category of the business ownership, I told you, partnership businesses. Under that, normally partnership business is having unlimited liability. What is unlimited liability? If you borrow money for the business is in the form of partnership, and the business is having a loss, you are going to shut down the business. You are selling all your properties and you have to pay to all your due, all your creditors you have to pay. All your, I mean, you are able to understand the word creditor, to whom you have to pay the money. Okay. Suppose you have taken loan from a bank, you have taken loan from a financier or a friend or anybody like that. If it is just a partnership, if the money available in the business is not enough to settle all the claims of the business to the outsider, the owner, the partners, suppose there are three partners, they have to bring from their own, from their private estate, from their private asset, the money to be paid for the loan of the business. That is called unlimited liability. Unlimited liability. The liability of the partners are unlimited in the case of just a partnership. So it has been viewed as a very big drawback of the business community. So people are reluctant to start a business in partnership form. Okay, because I have to bring my own property to settle the losses of the business. If I am going to close the business, Okay. So people were reluctant to start a business in this model. So government was thinking, why don't we address this issue? So they have introduced a concept called LLP, limited liability partnership. So here, if the partnership is having a loss, what I mean by loss, the total asset sold by the business is equal to 1 lakh, and the total amount to be settled by the business to the outsider is 1,20,000. That time, the money available, now assume the business is closed, the business is wound up. liquidated, dissolved. Okay. Amount available is 1 lakh. Amount to be settled is 1.2 lakhs. That time, the partnership is in the form of LLP means the partners will not be disturbed to bring the money from their own private asset. The 20,000 rupees is just written off by the creditors in proportionately based on the agreement or based on other formalities. But the point is, the partners, suppose 3 partners are there, they need not to bring any single paisa from their family, from their own, out of their pocket. Whatever is business is business. Business is separate and businessman is separate. That concept applies when you bring the concept of LLP, limited liability partnership. Sir, are you understanding?
Yes, sir. Yes, sir. Thanks for that clarification.
Yeah. Come to the same logic is there in the company form of organization. Company form of organization, the very basic difference between other forms of organization is limited liability. It itself is having a limited liability. Okay. The company form of ownership is having a limited liability. Suppose I purchased a share in Reliance Industry Limited. One share is equal to 100 rupees. I purchased 10 years ago. Now Reliance Industry is going to be closed. They are having more amount to be paid to the creditors. They have a lot of overdues. They have to pay. Okay. Now, I will not be disturbed. Sir, you are a shareholder. You purchased one share long back for 100 rupees. Now, the amount available in the company on the date of liquidation, on the date of winding up, is not sufficient enough to settle the loans of the outsiders of the business. So please bring the money from your private asset. No, that is not possible. Law gives the protection to the shareholder not to bring any single paisa from his own private asset to settle the loan of a business which is there in the form of joint stock company. It itself is the nature of joint stock company itself is that. But in partnership, it is not so, unless otherwise you registered it as a LLP, limited liability partnership. Okay. Now come to another question asked, private limited company. Just if I say company, I refer a joint stock company, which has shareholders. People may be using this word company. I'm having a company. That word is something different from the legal word company. He may refer a partnership firm as well, partnership firm or a sole proprietorship also as a company in a normal usage. But law, according to law, company means a joint stock company which is registered under Indian Companies Act 2013 or before that Indian Companies Act 1956. Okay. Companies Act gives 2 options for you to register your company. Of course, many are there, mainly these 2. One is private limited company, another one is public limited company. In both cases, liabilities are limited. Liabilities of the owners are limited to the extent of the money what he was agreeing to pay while buying the share. Okay, that's it. But what's the difference between this private limited and public limited? The shareholders of private limited cannot sell their ownership, cannot sell their shares to any third party without the consent of the existing shareholders. And the maximum number of shareholders also restricted to 200 in case of private limited. But public limited, it does not have any kind of restriction. You can buy the share today from the public limited company and you can sell to anybody without the knowledge of the other shareholders. Even without the knowledge of the company, you can sell to anybody. So the meaning is there is no restriction in the transfer of ownership in the case of public limited company. But there exists a restriction in the transfer of ownership in the private limited company. Okay, ICICI Limited is a public limited company. You can buy the share today, you can sell it to anybody tomorrow. Okay, so private limited company should have that word PVT in their name itself. In their name itself, Rajesh Enterprises within bracket private limited. So from there we can just understand it is a private limited company. Got it, sir? Yes.
Yes, sir. Yes, sir. Thank you.
Sir, can you explain this with an example? So we will. The same one you said that private limited companies are.
See, private limited company, does not allow its shareholder to sell the shares to third party, anybody. You can sell the shares to the existing owners. Suppose you and me are the shareholders of a company, or we have joined together and started a company in the name of private limited. Okay, later on the company is developing, getting success. I want to sell my shares to some third person because he is giving more money to me. I just want to quit the business. If it is a private limited company, I can't do so. Without your consent, I cannot go out of the business by selling my ownership to third person.
Okay.
Because you and me, very less number of people joined together and formed a business and worked for the business, made it a successful business. So I can't just materialize a profit by selling my ownership to third person without your consent. That is called private limited.
So for this private limited are the license are made in the beginning itself. Like
sorry,
I mean the license the what we say is
license is something different. License depends upon the business. What business you are going to carry out. We are not talking about the license. We are talking about the ownership. You can do any business. You can do a service business, or you can do a manufacturing business, or you can do a trading business.
Yes.
What business you are going to do, that necessitates, that demands the authority from which you have to get a license.
Okay.
Yeah, licensing is different. Licensing is for the nature of business. This is the ownership of business. Okay, right. So put the point to be very simple. Based on the nature of business, based on the ownership of the business, the language of business as an accounting, the language of business is slightly changing here and there. But the overall, the broad concept remains the same. Okay. So basically, accounting deals with recording of financial transactions. Financial transactions. What is financial transaction? Any transaction, any event which involves transfer of money or money's worth is called financial transaction or economic event or economic activity. Okay, giving an appointment order to a HR manager, is it a financial transaction? There was an interview happening.
No.
Yeah,
No.
absolutely no. Okay, giving salary to HR manager is a financial activity or a financial transaction. Appointing a person in the company is not a financial transaction. It won't find a place in the accounting books. Okay, so that logic you have to understand. I have
but there also salary
goods.
Discussion and all happening, right?
Yes, sir.
There the salary discussion is happening while appointing the person, right?
You can discuss 1 hour, 1 month, or you can do whatever the discussion. He is a very key person in that industry. You want him for any reason, so you brought him. You can have a discussion. Whatever you do, no problem. But that is not a business transaction. Here, according to accounting, it is not a business transaction. It is not a financial transaction. It's not an economic activity. You have given appointment order also. That is not a financial transaction. He has to come to the work for 1 month or 1 day or 2 days. Then you have to pay salary. That becomes an accounting activity. I mean, the
financial transaction,
economic event. Though you did not pay money, he has come to the company for 1 month. 31st of the month you have to pay salary, but you did not pay. That becomes a financial transaction. You did not pay. Really, the money does not go from the company to the manager, but that itself a business transaction because he has worked for you 1 month. The salary is due for him. Suppose he paid it. Absolutely, it is a business transaction, financial transaction. So economic event or economic activity or business event or financial transaction, if I say, it means any activity happening in the business which involves money or money's worth transferred from one to another. In the HR manager concept, appointing HR manager, money or money's worth did not transfer. You did not give a promise that you will give the money. You are giving an appointment order. If you join, if you work, this is your salary. That is not a contractual binding to you. Suppose he did not join, that obligation gone. If he joins also after working for 1 month, you are going to give salary. That becomes financial transaction. Now I give another example. You are a computer trader. PC, personal computers you are buying and selling. You are a trader. Okay, you are going to a computer manufacturing company. Okay, and you are buying some computers. 1,000 computers you bought in a specific configuration and everything. 1,000 computers you bought. and you did not pay any money, and you just told them, you promised them, I'll sell these computers and I'll pay gradually within 3 months. Now there is no money transferring from you to that company. Is it a transaction?
Yes, it is a transaction.
Yes,
You
it is
bought
a
a goods.
transaction
You
because
bought a goods on a
you-
credit
yeah,
terms.
you have promised and you have purchased goods and you have given a writing. Yes, sir, I have bought 1,000 computer. One computer is equal to 20,000. The total of this I will pay you within 3 months. So that is a financial transaction. Okay. So non-financial transaction and financial transaction. Accounting bothers about only financial transaction. Sir, he is very honest. This person is very honest. Let him be. We don't worry about that. Honesty. Okay. He is very key personnel. He is having more technical know-how. Everything is fine. But finally, what happens to business? Are you getting money? Are you paying money? Are you getting a promise of getting money later? Are you giving a promise of paying money later? That constitutes the concept of financial transaction. Okay. After that, so first you have to identify the financial transactions, then you have to record such financial transactions. Okay. Then you have to process the financial transactions after the recording. Then you have to communicate to the owner what has happened in the business in a particular period of time. So that's about informing about the performance of the business. Performance can be up to. One is what is your achievement, what is your profit you earned. That's one performance. Another one is financial position. What is your position today? I'm not telling about the market position. First, second, third. I'm not telling that. How much you are owning and how much you have to give to others. That is called financial position of the company. One is for the current year, how much you earned. That is operating performance. Another one is how much you have today. Whatever you earned today and whatever you had before, both together, what is the total amount available in the company, total resources available in the company, and what are the total values to be paid to outsiders on a particular day. That's called financial position. Another one is financial performance. Profit is performance. What is your status today with regard to your assets and liabilities are called as financial position. We'll see in detail little later. Okay. So you know very well, money is there from their time itself. Accounting is there, and it's becoming today a separate profession because of joint stock company form of organization. I already told you, owners are residing throughout the world, but company is running in one place. Somebody is taking care of the company. How far the management is taking care of the company should be watched by somebody. That watching is being done by accounting. So because of more number of joint stock companies in the world, accounting profession has become a separate profession. Look at this diagram. It gives you the basic idea about the accounting. Look at the left side, economic events. Economic events means financial transactions. That is being identified by the process, okay, by the accountant, and it is processed by the accountant based on some rules and regulations. That is called accounting process. After processing the data, see, economic events are captured by means of data only, right? Payment of 1 lakh rupee a salary to HR manager. 1 lakh is data. Okay. Every economic event which can be measured by monetary terms are being captured. That captured data is being processed based on the rules and regulations of the accounting, and the result of such process is being communicated to the needy people. The main person who is in need of accounting result is the owner, the manager, and all other stakeholders. Okay, so communicating such result of the economic events after a due process to the needy people. That needy people take that result, take that information, processed information, they will use it for making some decisions. Simple example, suppose you want to buy the share of a company. Some IPOs are coming up, IPO, initial public offering. The companies are selling the shares in the beginning itself. Or there are existing company, they are selling the share. Buying and selling of shares are available through stock exchanges. So you want to buy a stock of a company. How do I buy? So based on the accounting information, you take your decision. Internal users and the external users. Internal user means the owner, the business owner, shareholder. In the case of joint stock company, partners in the case of partnership firm, or the single owner in the case of proprietorship. Okay, external users, suppose a bank, you are approaching a bank for a loan. Bank will not blindly give you loan. They ask for so many information, such informations are coming from accounting. Okay, so they use that information from your accounting. They decide whether to work getting a loan or not. Then they will decide whether to give a loan or not. Again, the flow is there. So this is what the accounting process. Not required. Okay. So this is what we discussed: the sole trading era, partnership era, Hindu undivided family era, then cooperative form of business era, then corporate era. Today we are in the corporate era. So so many businesses are in the. So I can't say number of units are more in corporate form. Company form. Corporate means company form. Okay. But the volume of transactions done by the corporates are more than that of the other forms of business ownership. That is why corporate form of business ownerships are getting more significance. So accounting has been looked at a separate discipline only from corporate business point of view. Other businesses will not have that much significance to accounting. Of course, they do have accounting system, they do have everything, but not as significant as in the corporate form. Okay. So having understood all these things, come to the formal way of understanding what is accounting, because we have to write in exam, or we have to understand rightly what is accounting in a formal way. So accounting refers to the process of recording the business transactions, classifying such business transactions into so many categories, and summarizing the business transactions. Okay, business transaction means which can be measured in terms of money. Okay. And then preparing financial statements or financial reports. After preparing that, analyzing such data found in that report, then interpreting the result of such analysis and communicating those interpretation to the needy people to get some meaningful information for guiding the management or to take some managerial decisions. Okay. Some authorities define the term accounting. AAA, that is American Accounting Association, gives a definition like this: a process of identifying, measuring, and communicating economic information to permit informed judgments and decisions by the users of information is called accounting for this American Accounting Association. But whatever the authority can define, but simple, I have to understand what is happening in the business with regard to business event. I have to carefully identify and capture that, and I have to measure it, how much it is, how much salary paid, how much rent paid, how much raw material I purchased, how much electricity bill I paid, everything. I'm measuring it, and then I'm just analyzing it, how much I have earned the profit. What is the profit? Anybody can tell me what is the profit? We have been using this from the beginning. When I was asking about business, somebody told profit also. What is the profit?
It's the revenue.
Whatever the revenue.
The money, the money which is remaining after all the transactions.
Money remaining.
Sir, is the revenue? Is the revenue out of the investment which we have done?
Okay.
That net
money
result of
available
our
after
business transactions.
incurring everything means, suppose I don't have money at all in the last. I have purchased material for 1,000 rupees and I sold it for 2,000. But the customer did not give the money. He told I will give later. So what is the profit now?
So
are you getting my point? What's the profit now?
Can you just repeat, sir? What
I bought a good for 100,000 and I sold it to a customer for 2,000, but the customer did not pay the money immediately. He told me I will give you after a week. What is my profit now?
Still
the traffic will be 1,000 rupees.
It is a credit sales. It is a credit sales which is made, and you incur. I mean, you what do you call, recognize that money once you get that after.
But what is available with me right now? Nothing. Zero.
Zero.
Yeah. But in spite of that, I am telling my profit is 1,000. So simple definition for profit: excess of income over expenditure. Can we say?
Yes.
Excess of income over expenditure of a business.
Yes.
Of a period of time, but for over a period of time. For 1 month, what is the expense? 1 month, what is the income?
Absolutely.
So The difference between these two, if it is positive, revenue is greater than the expenditure, then there is a profit. If it is other way around, there is a loss. Okay. Now, being an accountant or being a student of accounting, we should know how do I recognize the income and the expenditure. Look at the word. Profit is an excess of income over expenditure.
Yes.
So I should be very careful enough in measuring what is income and what is expenditure. Then only I can arrive at a right amount as profit. If I recognize something which is not to be recognized as income, then my profit is inflated. If I recognize an income, if I forget to recognize an income which need to be necessarily recognized as income, then my profit is deflated. I mean, coming down. Okay.
Declining, yeah.
Same way, expenditure also. So you should be very careful enough in this equation. Income minus expenditure is equal to profit. Mathematically fine. Everybody accept it. There is no doubt. But where the accounting comes into picture? The accounting comes into picture in suggesting you, in educating you, in enriching you what need to be recognized, what and all need to be recognized as income, and what and all is to be ignored from recognizing as income. The same logic is applicable to expenditure as well. We will discuss in detail little later. So profit. So identifying a business transaction, recording such transactions. Why do I record? Just I told you, 1,000 rupees, I bought a good, I sold it for 2,000, my profit is 1,000, immediately told. I did not record anywhere. Why should I record? But it's only single transaction. But in the business, there may be innumerable number of transactions happening even in a single day. So I can't remember everything, my mind. So I can't remember. Okay, so I have to keep a record of something in some books. So there comes recording of business transactions. So after recording, you are just going to compare. Please understand, accounting is not that tough as you think. It's very easy. It's very, very easy. Compared to your calculus, compared to your engineering concept, nothing. Accounting is nothing for you. It's very simple. Profit is the motive of business. That's what you told in the beginning. Of course, true. But accounting does not attempt to increase your profit. Accounting is just measuring your profit. Accounting is a measurement discipline. Please understand. Accounting is a measurement discipline. Accounting measures how much is your profit. If you want to measure the accounting, the profit, you have to have yardstick for that. The yardstick is something I told you an equation, I minus E, income minus expenditure. So I should know what is income and what is my expenditure. So profit. Identifying the business transactions, recording such transactions. Recording only is being guided by what is to be recorded and how it is to be recorded, and what is an income, what is not an income, what is expenditure, what is not an income, as an expenditure. That is being guided by the accounting principles, which we are going to see little later. Okay. So after that, you are just comparing these two and finding out the profit, and you are telling to the owner that this is what the profit. Please don't be under the impression that accounting increases the profit. No, the basic objective of accounting is to find out. Look at the word, under the word find out the profit. That's a basic objective. Second objective is to know the financial position of the company. You have a lot of transactions, you are buying, you are selling, you are getting a promise, you are also giving a promise to others to pay the money later. So all these happenings are there. At a given point in time, what is my position, sir? Sir, I have how much? Owned. What is owned by me, owned by the business, and what is owed by the business? O-W-E-D, owed by the business. How much I have as a resource, how much I have to pay to outsiders as a liability. Look at the word I'm bringing, the concept which can be normally used as well as accounting, very particular concept, liability. Liability means any value which are payable to others by the business is called liability. Asset is what you own, what is the resource for you. Okay, so just comparing assets and liabilities also, and you are making a statements that this your asset, this your liability on particular day. So basic objective of accounting is just 1 minute, sir. Somebody is raising hand. Just 1 minute. Okay, so objective of accounting is just two. One is to find out the result of the business. Result of the business, that is through profit or loss. Result of the business is nothing but performance of the business that is told either in profit or in loss, depending upon the case. Okay. And then to know the financial position of the company. These two are ancillary. The first and last is ancillary objective. The two objectives are very, very core objective of a business. I repeat again, the objective of accounting is to find out the financial performance of the business. When I say financial performance, I am saying the profit earned by the company or the loss incurred by the company. Okay. Then second major objective of accounting is to know the financial position of the company. What I mean financial position? What is the asset of the business? What is the liability of the business? A statement about that is financial position. Okay. These two are the basic objectives of accounting. Now I take your question. Somebody raised a hand. Yes. Yes, sir.
So it's Vikrant here. My question is like fixed asset and current asset. Okay, so if we'll say in March financial year 2019, if a company fixed asset is 100, and in March 2020 the fixed asset is became 150 crore, so it will be considered as a profit, or how should we?
No, that's what. No, what is profit? We just understood what is profit. According to me, or according to accounting, just now I educated you what is profit. Profit is equal to
income over expenditure.
Just I told you, no, profit is equal to
income minus expenditure
is equal to income minus expenditure. But you are comparing something else, right? I am telling you to compare what? Income with expenditure, but you are comparing some other variable. So that cannot be a profit. Okay. That cannot be a profit, right? Profit is always equal to income minus expenditure. But you are taking about some asset. You've taken some asset of last year and asset of current year, and you are comparing these two. Two mistakes are there. Two illogic are there. What are they? One is the variable itself is irrelevant to the profit. Second one is income of the current year and income of the expenditure of the current year need to be compared. Matching. This is called matching concept. We call it as matching concept. You are matching your income with expenditure. You are also matching there as only one variable of 2 point in time you are matching. Asset of 2019, asset of 2020 you are matching. The variable what you are matching is irrelevant to the profit, and again another irrelevance is the time period. Income of 2020 and expenditure of 2020 need to be compared, not of asset. Okay, in your analysis you can say that is analysis. What you are telling is called analysis. What you have done, you have just taken the variable of asset of last year and asset of current year. You are just telling, sir, last year my asset was 100 crore, current year my asset is 110 crore, so my asset has increased. That's one simple interpretation. Why it is increased, how it is increased, then you have to dig so many other information that we do it in the last chapter, last but one chapter called financial statement analysis. Now the asset of 2019 is nothing but the financial position of the company. The financial position of the company refers to the assets and liability statement I told you. Since you brought that concept asset 2019, in 2019 your company was having 100 crore as fixed asset or current asset or name of the asset, building, car or furniture, whatever it is. That comes under financial position. Financial position of the company will increase if the company is doing a good result in the business, right? That's interrelated, no? Interrelated. Keep on earning more profit. Definitely profit can be in cash or can be in any other form. Okay, that will come under financial position. Your financial position will get improved whenever there is a continuous improvement in your business performance. Got it, sir?
Thanks, Professor.
Yeah. Right. So I hope it is very clear. Objectives of accounting. I'm just telling about just like 11th standard student. Okay, don't think that I'm just going very, very slow and very basic concept. I want to make it very clear. Okay. So at the same time, I expect you to understand clearly. No doubt later. basic objective of accounting is to know the result of the business, to know the financial position of the business. These two words you should never forget if you claim that you studied accounting. Result of the business, financial position of the business. Okay, only 4 words: result, financial position. That's all. Okay. If you want to know the result, automatically it need to be recorded. Without recording, I can't find out the income minus expenditure, because income is not earned in a single point in time. It's earned over a period of time. So I keep on recording. Okay. At the same time, financial position also I have to understand, means I have to record. Whenever I buy something, I have to record. Whenever I sell something, I have to record. Then only I can find out the net financial position. Okay. Then recording, knowing or finding out is fine. If you find out and keep it with you, no use. So you have to communicate such information to the different people who are in need of it. So this is what the basic objective of accounting. Okay, this is another concept. Who are those users? I told you here, various groups. Who are those various groups? The groups can be internal users and external users. The needy people of accounting information may be internal and external. Who are those internal? The owner himself, the management, and the employees. These 3 are very much interested in knowing about your accounting information. What is my profit? Based on that, I can plan something as a owner. Based on that, I can claim something as a manager. Bonus or remuneration. Employee are the same thing. Okay, they can feel proud that I have helped the company to earn this much profit. So please give me a bonus of this much. Could be possible. So these 3 people are very much interested as an internal person to know about the accounting information. Then come to external users of accounting information. Creditor. Who is a creditor? Is it
Supplier.
accounting term? Normally also it is used, right?
Anybody who lends money.
Suppliers or a shareholder.
Simple, yeah. The first one I take it. Anybody who lent money is called creditors. Who is lending money is called creditor. Suppose I have taken 1 lakh rupee loan from you, then you become a creditor for me. Then I become a debtor for you. Please, engineers, we are going with some technical terms. Please understand. Creditors means any entity or any person, any entity or a person who has claim on others. Who has claim on others. Suppose you have taken a loan, bank loan, personal loan. The bank is your creditor. For the bank, you are debtors. You are called debtor. Okay, you are called debtor. For the bank, you are called debtor. Okay, we will discuss that later. But now you understand, creditor is interested in your accounting information, so that how much money is coming as interest from you, when can he get it, how much he can lend to you, when can he get back that money, everything he is interested in knowing about your accounting information. Then financiers, of course, one of the creditors are financier only. Financial creditor, both are same. Or you can say here, if you buy goods from somebody, they are called as trade creditors. If you're not taken any loan from anybody, but you've taken computers. In my example, you've taken computers, you purchased computers without paying money. Those people are called as trade creditors. Trade creditors. Suppose you take money from somebody, hot cash, money from somebody, they are called as financial creditors. Financial creditors are simply financiers. Okay. But broadly, creditors are nothing but a person or entity to whom we have to pay money. Okay. Why we have to pay money? You have purchased goods from them. They are the trader. Their business is not lending money. They are just another business unit. They have given goods to you on credit basis. You bought goods from them without paying money today. So they will be called as just trade creditors, or you can call them as sundry creditors. Sundry creditors. Sundry creditor means so many people, including many people. Rajesh Enterprise, Ravi Enterprise, Usha Enterprise, put together is called sundry creditors. Financial creditor means a bank or from whom you bought money, sorry, from whom you taken loan is called the financial creditors or simply creditors. Then potential investors, somebody is looking your company very closely to invest. So they need accounting data to analyze how the business is going on, to invest their money into your business. Then consumers, they want to know about the price of the product. So they want to know about your accounting information. Tax authorities, we live in a country where everything is being taxed. Okay, everything is being taxed. Okay, so government is always watching the business units, how much they earn profit. Immediately they want to take something from the profit. So for that, Government of India, tax authorities are having a need of your accounting data, accounting information. Then government, for so many other planning, they need your accounting data. And the student and the research scholars to do some research, to do some analysis, to learn something, or to understand the business statement, everything. They also in need of your accounting information. Okay, so these are the various external users of accounting information. These are the internal users of accounting information: owners, management, employees. Okay, let me give you some 10 minutes break. Just take 10 minutes break. We will be assembled at 11:15. Is it fine?
Okay, sir.
Yes.
Fine, sir.
Yes, sir. Thank you, sir.
We'll be back.
10
Sure,
minutes
sir.
break. Yes.
ನಮಸ್ಕಾರ 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 ಹೇಗಿದ್ದೀರಾ?
Yeah, welcome back. I'm audible now.
Yes, sir.
Yes, sir.
Yes, sir.
So before
We
we
can
start
start now.
any
The
kind
volume
of
is very low, sir.
volume is low. Okay, let me check. Yes. I hope now it will be right.
A little more. It's sounding like very thin voice.
Sounding very low decibel.
Yeah.
Okay, now I am very closer to the mic. Okay, let me check.
This is fine, sir.
I'll speak a little louder also. Yeah.
Okay, sir.
Yeah, but now it is clear.
Right, right. So
Yeah,
any queries before we start? Anything you would like to say with regard to the concepts what we discussed so far, or anything comes to your mind with regard to the concepts what we discussed?
No, sir. All clear.
Good, sir.
All clear. Okay. So we discussed the introduction, meaning, definition of accounting, objectives of accounting. Okay. Then users of accounting information. Next, branches of accounting. Actually, it is not there in the practice as separate branches. In practice, in the companies, these three will be interrelated to each other. They won't have a separate section like you, section A, section B. They have different timing, they have different teacher, nothing like that. But academically, we have these three concepts: financial accounting, cost accounting, and management accounting. But in reality, in practice, these three will be there, but there won't be any concrete wall between these two or three. All the three will be mingled with each other. Okay. What is financial accounting? Whatever we discussed so far is called financial accounting. Right from the identification of business transactions and ending with the preparation of financial report. Preparation of financial report. When I say financial report, it includes two. It includes two. One is based on the two objectives. One is to know the profit or loss. We prepare one report that is called profit and loss account, or simply income statement, or statement of profit and loss. Okay. Second objective is to find out the financial position of the company. That is being achieved by preparing a statement. That statement is called balance sheet. I repeat, financial accounting refers to a process of right from the identification of business transactions and ending with just preparation of financial statements or financial report. Okay, what are those financial report? I told you two reports, two statements. What are those two statements? To achieve the first objective, one statement, that is profit and loss statement or profit and loss account, or some author may call it as income statement. Second statement is balance sheet, which is prepared to find out the financial position of the company. Okay, so if you do with this, if you end there, that is called financial accounting. Okay, then management accounting. What is management accounting? After producing, after preparing, after finalizing the report, you analyze the data in the report. That is called management accounting. So management accounting is a process of analyzing the data supplied by the financial accounting through the financial statements, so that I can just interpret, I can just connect one variable with another, and I can find out some kind of relationship between two or more variables. Based on that, I can give an interpretation. Based on that, the management can take some managerial decisions. So that branch of knowledge, that branch of techniques is called as management accounting. Okay. Then obviously you can understand now cost accounting is nothing but a branch of accounting which deals with two things. It deals with finding out the estimating or finding out the cost of a product or a service depending upon the nature of business, and to exercise the control over such cost. Cost accounting propounds certain rules and regulations, certain framework, certain methods, tools, techniques which are helpful in identifying, forecasting, finding out a total cost of a product or a service, and to have a control over such spending, to have a control over such cost. So these three are the branches of accounting, but in general, all the three are interrelated to each other. To find out a cost, you should know what is the price of the raw material. The price of the raw material data will be available in the purchase book that is maintained by accounting department, financial accounting department. So all these three put together only we have a accounting system. Okay, we nowadays living in a more sophisticated information technology era. So all these are automated. All these accounting processes are automated. Most of you may be experiencing this in your companies. Okay, we're starting from very basic level of ERP, a tally ERP, tally. Okay, our customized ERPs are there. There are many companies, they're customizing and giving the ERPs.
Hello, has meeting started?
Sorry, sir? Sorry?
Yes, class is going on.
Okay, somebody is asking.
Somebody
Okay,
joined
fine.
just now.
Let him join. Okay, so the point what I'm trying to say is automated system is available today. Any ERP the companies will have that will automatically take care of these three. Okay, when and wherever there is a transaction happening. Okay, so this is called branches of accounting. Next, limitations. Only one limitation I'll tell you later. You can read is accounting records the monetary transaction, does not consider any non-monetary event. Okay, and it does not worry about the time value of money. What is time value of money? 1 year period you are finding out the profit. The purchase what you made in January 1st, the price need not be the same as 31st December. But in accounting, we don't have a difference between that price and this price. We just add. To find out the profit, we minus expenditure from income. In expenditure, you have to total all the expenditure. One of such expenditure is purchase of goods. Purchase of goods will not happen only one day in a year. It will happen many times in a year. So the purchase of goods made on 1st January will be less costlier than that of the goods purchased on 31st December. Over a period of time, the price of the goods are increasing. That's what we call in business or in economics inflation. In finance, we call it as time value of money. So we just add that to 100 rupees bought on 1st January. The same goods purchased 31st December is 120. But for us, the profit equation in the expenditure category, we just add this 100 plus 120, 220 my total expenditure on goods. We don't mind when it was purchased. Okay, why that 120? Okay, we ignore the time value of money. In accounts, we just ignore the time value of money. We just go with the real data, real spending. How much we are spending, that will be taken into consideration. Okay, like that there are other limitations. These two are the most important limitations. Next. Yeah. This we will discuss a little later. Okay, now come to this. I already told you. Over a period of time, we have evolved a lot of framework, lot of rules and regulations based on which the accounting should be followed, accounting practice should be followed. A person who is in Bangalore, a person who is in Pakistan cannot follow two different concept of accounting, two different ideology of accounting. If they follow like that, there will be a difference in comparison. Suppose you are studying in Rajasthan University, accounting for managers subject, and one of your friends may be studying in some other Delhi University, maybe accounting for managers subject. The syllabus should be, the basic idea should be the same. You can see MBA curriculum of any universities in the world you take. The basic concepts will be the same. Okay, content may be here and there different. Okay, the methodology of delivery may be different, but the basic logic, the basic broad category for the knowledge to be inculcated to an MBA graduate, that remains constant. Likewise, here also, the concept to be followed by all the accountants across the world should remain constant, should remain the same. For that, the accounting discipline has evolved certain concepts and conventions, so that a comparison will be logical. You in MBA curriculum and the Delhi University MBA curriculum, the result A plus or B plus, you can just compare. I have got this much, you have got that much, because the fundamental basic concept of MBA remains the same. Likewise, in accounting also, certain things need to be common across the world, across these disciplines. But understand, please, all of you, it is not a science. You can say law of gravity. Okay, the rules and regulations in science, most of the sciences, it remains same all over the world, all over the world. Okay, universal applicability is there. But accounting comes under arts. It has its own differences. It has its own flexibility to get altered from place to place, time to time, from country to, person to person. But to most possible way, such flexibility should not result in confusion or illogical comparison. For that purpose, we have evolved certain concepts and conventions which need to be followed throughout the world if you are practicing the profession of accounting. Such things are displayed here. You can see in the slide. Accounting concepts and accounting conventions. First concept is business entity concept. What do you mean by business entity concept? Though you may be a owner, you are only giving the money to the business. It is your money. Suppose 10 lakh you are bringing from your home, from your pocket, and you are starting a business in a sole trading organization. But for us, as far as accounting is concerned, you may be a owner. You may be the sole authority. There is no second owner for that business. But accounting considers you as an external person. You are a owner. Though you are a owner, you and the business is separated from each other. The money what you give, you are creating an entity. Rajesh is the owner, but Rajesh Enterprise is the business. For accounting, Rajesh is separate person and Rajesh Enterprise is separate. So whenever Rajesh gives money to the business, Rajesh Enterprise receives the money. Whenever Rajesh Enterprise, the business gives money to Rajesh, he is receiving the money. So both need to be accounted. Both need to be recorded. So that the business will, the accounting will reveal the true profit or the true performance of the company. Okay. So for any business for that matter, it can be any form. Just I take an example of sole trader, that's all. So accounting treats the business is separate unit and the businessman is a separate person. The transaction between these two people need to be properly recorded. Money giving or money taking, or suppose you are running a petrol pump, you are the owner, petrol pump you are running. Your son is coming there and filling the tank, a car. Okay, 20 liters diesel or petrol is filling. It need to be recorded. You cannot just, it's my petrol pump, I just take money from my business. You can take. No, but accountant does not have the right to say, no, you cannot take. That is your choice. Their accounting does not come and interfere. But if you take, please tell us, we will record it. Okay, then only I can find out the true profit of the business. I hope you are understanding. Business is separate from the businessman with regard to accounting is concerned. So the financial transaction between these two need to be properly accounted. Another example I'll tell you to make it very clear. Suppose you are the owner in the petrol bank and you are standing there as a manager. You are looking after the business for a whole day, for an entire month. Okay, you did not appoint anybody as a manager. So your salary need to be accounted. If you do not recognize that work what you contribute to the business, then automatically accounting will give a more profit. Accounting will show more profit than originally it is. Because in the place of you, if you appointed another person, you have to give salary for him. So that need to be minused. If you don't treat business as a separate unit and you are a separate person, you will forget to record that salary. That's called notional salary, notional. Or simply salary to the owner. You take 10,000 rupees per month. So from the total profit, 1,20,000 would be reduced. Why it is to be reduced? Because it needs a person. But you are only giving that labor. You are only giving that expertise. You are only giving that managerial responsibility for your own business. It needs to be accounted. Any doubt in this?
No, sir, all good.
Yeah, perfect. So going concern concept. Next one is going concern concept. What does it mean? Going concern concept refers to the business is forever. No business is started for just closing down in the near future. Men may come, men may go, but the business will be forever. I am not telling about legal point of view. For accounting, it is like that. From the legal point of view, sole trading organization may have lesser life than that of a company form of organization. Reliance Industry Limited is there. Ambani or Ambani's son coming and going, no more, no problem. But the company will remain forever. That is company form of organization. But suppose sole trading organization, Mr. A has started the business. Mr. A dies. A's son does not like that business. He can close it, no problem. It does not mean that it should go on forever. But in accounting, for accounting, we assume the business is forever. The business is not started for closing down. Why we assume that? We are borrowing money from somebody by saying that I'll give you next month. You are assuming next month he is also going to do a business, you are also going to do a business. Then only that indebtedness comes into picture. Indebtedness. Okay. That is what we call it as going concern concept. The business is always going on. It is not for stopping the business. Business is not started just to close down in the near future. It can be done. Accounting does not come in your way to restrict you not to close down your business. You can do. That is a managerial decision. The owners have decided to close. Accountant is an employee. Accountant is an employee. Accounting is just a concept of accountant. That's all. It does not restrict you not to close the business. But accounting assumes the business is going on forever so that the indebtedness can be recorded properly. Okay. Then accrual concept. Accrual concept means that the revenue or the expenditure of the current period need to be considered in the current period, irrespective of that is paid or received in cash. I repeat again by an example. You have deposited 1 crore in the bank. The business has deposited 1 crore in the bank. Bank is giving 10% interest on your fixed deposit. So how much interest you have to receive per year? How much interest you have to receive per year? How much?
10 lakh. 10 lakhs.
Yeah, 10
10
lakhs
lakh.
I have to receive. 10% on 1 crore is 10 lakhs. 10 lakhs, sorry. For easy understanding, take 12%. Take 12%. Okay. So 12 lakhs I have to receive as an interest. But the bank is having a policy of giving interest twice in a year. Twice in a year. One is 31st March. Another one is after 6 months. That means April,
30th.
May, June, July, August, September.
30th September.
30th. September 30th, it will give another interest. But your company has deposited the money on 1st January. On 1st January. Okay. When will be the first nearest date of receiving interest? 31st March. 31st March. Okay. If the bank has given 31st March the interest, it is due for 3 months. Okay. But you are closing your books of accounts. You are closing your books. Suppose you want to close. Close means what? You want to finalize. You want to know the results of the business. The date of knowing the result of the business and the date of receiving the interest, if these two dates are different from each other, that time, the interest what is earned, taking the same example, 1st January I deposited the money. 31st March I have to receive the first interest. How much?
4 lakhs.
4 lakhs I have to receive. Only for quarter, 4 lakhs I have to receive. 4 lakhs I have to receive. Okay. Suppose the bank is giving, take another slight change in that for my convenience. The bank is not having a habit of giving interest on 31st March. It is having a habit of giving interest on 30th June and 31st December. They give the same 2 times in a year, but I am changing the date for my convenience of telling the example. Okay. 30th June only you will receive the interest. Second interest you will receive on 31st December. Now you deposited on 1st January. You have been waiting for 3 months. Accountant is going to close the books of accounts and he wants to find out the profit or loss of the business on 31st March. Because government wants my account to be submitted on 31st March. That time, till 31st March, how much I have received as, underline the word, received as interest?
0.
0.
2.5 lakhs.
So when did you receive?
Zero.
The company deposited on 1st January 1 crore, rate of interest 12%, agreement saying that 30th June and the 31st December you will get the interest from the bank. Now,
As per agreement, we have to calculate interest.
Wait, sir. So till now on 31st March, you did not receive any interest. Are you agreeing that?
Yes, sir.
Yes, sir.
Yeah.
Yes, sir. Zero interest.
You did not receive any interest. But you are going to receive interest on 30th June for 6 months. That 3 months included in the current accounting year. Okay. So you have to calculate. Though you did not receive interest in cash or credited in your bank account, but you earned the interest. The business has earned the interest. How much earned? 3 months over. My money is let be in the bank for 3 months. So 3 months interest I have to calculate. I have to consider that also as an income to the business. Though you did not receive the interest on 31st March, but on 31st March, you did earn the interest. How much you earned?
2 lakhs.
10 lakhs, 1 crore into 12% into 3 months by 12 months.
3 lakhs.
3 lakhs.
3 lakhs.
3 lakh.
3 lakh rupees you earned. But 3 lakh rupees you did not receive. You cannot go and ask the bank, sir, give me the money, I want to credit my books of accounts. I want to close the books. Bank will say, no, my policy is giving interest once in 2 times in a year. That's on 30th June. So we have to record that
Accrual.
3 lakhs as interest receivable. Interest earned but receivable. That's called accrual concept. Accrual concept. Interest accrued but not earned. Sorry, but not received. Accrued means due. Accrued means due in this case. Due. Okay. Same thing, reverse. You have to pay some money to others. Okay, which is relevant to this current year. But you are going to give it in the next month only. They have rendered a service to you, but you did not pay money to them. But that service is of current year. You cannot ignore that expenditure. Though it is not paid, you have to recognize that as an expenditure in the current year itself. So that's also an accrual. That's from the point of view of expenditure. This is from the point of view of income. So accrual concept. Okay. So accrual concept is telling us to recognize all those incomes and expenditure relevant to a particular year, though it is not received, though it is not paid. Next, money measurement concept. This we discussed already. First itself, I told you, appointment order given to HR manager is not a financial transaction because of this concept. Money measurement concept advocates the accountant to record only those transactions which are capable of measuring through money.
Usually the
Money
video.
here refers to not INR, not USD. It's value of money, that's all.
Mummy bandra.
Money measurement concept. Okay. In accounting, we can record only those transactions which can be measured through money, monetary terms. If it cannot be measured through monetary terms, simply be avoided, simply be ignored. Okay. Next, dual aspect concept. Dual aspect. What is dual aspect concept? Somebody asked whiteboard. Okay, let me do that. If any example comes, I'll do that. Yeah. Somebody is requesting me to use the whiteboard. Yeah, I'll do that if it is required. Okay. So the next concept is dual aspect concept. This dual aspect concept is a brainchild of a concept called double entry bookkeeping. Double entry bookkeeping. Up to 14th century, we don't have this concept. We don't have this modern way of recording books of accounts, modern way of maintaining or keeping books of accounts, or this accounting discipline as a modern discipline. They just write. I paid money, 2,000 rupees to Rajesh, received 5,000 rupees from so and so. I purchased this money goods. Like that, they will write it those days. That concept was called as single entry system. Single entry. They just write what has happened. But today, for our convenience, here only the debit credit comes into picture. Engineers, please don't worry about this. I'll explain a little later. Each and every transaction. Can anyone tell me any one particular transaction? I'll just take a person. Anand, yes. Are you there? Anand, yes. Mr. Anand, are you there? Anand, yes. Okay, Anand, yes, is having some problem. Okay. Anybody?
Yes, sir.
Arjun K. Anand, yes, you are there? Yes, sir.
Yes, sir.
Anand, okay, thank you. Thank you. Can you just tell one business transaction in a business? Example, one transaction.
Acquiring antivirus software, like
Sorry?
buying a software.
Buying a software. Excellent. Buying a software. Which company you are working for, sir?
I'm working for Avankia.
Okay, okay. So from that line, you are like buying a software. Okay, fine. Absolutely fine. Buying a software. Okay. Now, this is a transaction. Buying a software. For how much, sir?
Let's say like 1 lakh rupees.
Let it be you. Not your money, not my money. Company money. So 1 lakh rupee.
Yes, sir.
Rupee. Accountant does not worry about this. Okay, accountant, financial controller, the treasurer, finance manager should worry about that 1 lakh is worth or not. Accountant is just going with the bill. Okay, there is a bill coming to us, invoice coming to us. If it is written 1 lakh, we just take 1 lakh. Otherwise, the amount what is mentioned over there. Okay, fine, thank you. So Anand is telling there is a purchase of software for rupees 1 lakh. Now I'm trying to explain the concept of dual aspect. Okay, dual aspect means each and every transaction will have two aspects into it. What is the two aspect into this particular transaction? Anand's company is getting the software. The resource of the company is enriched, added, going up. Okay. At the same time, the resources of the company of today, the money goes out. Are you able to understand? If a new resource comes in, the existing resource goes out. So in the net result, 1 lakh cash or bank balance comes down, reduces, and the asset of the company so far, okay, the software, the block of assets, software, so far it is 10 lakh, now he is buying 1 lakh worth of software, so it becomes 11 lakh. So each and every transaction is having two-fold effect. One is benefit giving and another one is benefit receiving. If you record both the aspect of a particular transaction in the books of accounts, that is what we call it as double entry bookkeeping or dual aspect concept. Those days before 14th century, why I'm telling this 14th century, in 14th century only the modern accounting system was invented by a person called Luca Pacioli. In Italy, this concept was introduced, dual aspect concept or the double entry bookkeeping concept. Okay. I repeat again, don't worry about the person here and everything. We are not going for a understand simple logic. Each and every transaction will have definitely two aspects. One is benefit giving and another is benefit receiving. According to dual aspect concept, it is recommending the accountant to record both the aspects into the books of accounts. That's what about dual aspect concept. Okay. Next, cost concept. It's very, very important concept. Cost concept. Anybody in this session can explain what is cost concept?
Recording
Anybody who is
transactions
from commerce
and
background or accounting, accountant? By the way, anybody is working as accountant in accounting department or somebody like that? Yeah. Somebody is raising hand. Yes, sir. Raghu. Raghu sir is raising.
Raghu says.
Yes, Raghu. Please go ahead.
Yeah. Cost concept in the sense like accounting transactions in perspective of costing, like labor cost and material cost, to give the cost of a product.
No.
Usually manufacturing companies follow this concept.
No. It's not. See, all these what is displayed over there in front of you, the screen, is not for any one type of organization, any one nature of business. It's for everybody. Cost, what you are telling is correct, but cost concept, what we refer here is something different. Anybody?
It's basically,
yes,
yeah, sir.
So it's okay. Sorry.
So basically, the cost principle is basically like irrespective of anything, just to see how at what cost the asset was purchased and what cost it was acquired, and what is their life of the assets in the future years as well.
Exactly. So accountants should not worry about the real value of the goods. Accountants should always worry about how much is agreed to give or given. Simple example. Suppose near to our Dayansagar University, I don't think so much of you might have visited there. There is a building, no, in electricity, before electricity. Near to that, there is a land. Suppose our university wants to buy that, purchased. The real worth today is something around 10 crore. But since we need it, we just purchased it for 11 crore. 11 crore. The real worth is 10 crore. So 10 crore means so somebody else.
Can you please mute, please, everybody?
Yeah, please, the people who are not participating, or everybody, please mute yourself. Whenever it is required, you can mute. Yeah. So we purchased a land which is currently market value of rupees 10 crore, but we purchased it for 11 crore because we needed it. We needed it. Or other way around, there's a land which is worth rupees 10 crore, but you bought, since there is a very secret deal, you did not give them time for displaying advertisement and all, you bought it for 9 crore. Irrespective of these two, you have to write the amount for which you bought it. That's what the gentleman was telling. Cost concept recommends the accountant to record how much you really spent or how much you really promised to pay. Rate at which you acquired an asset or anything, that rate should be entered, not the real cost. Real cost means the market value or any other value to be recorded. You might have spent more or you might have spent less than that of the market value. Don't worry about that. Being an accountant, you should write. In the previous case, Anand's case, 1 lakh rupees is to be returned in the book for the purchase of software. That's all. If you spend any commission, on that, you would write that also along with the cost of the software. So cost concept tells us to record only the actual cost. Actual cost means don't think about the real money what I spent. Actual cost means how much I agreed to pay or I paid. In my first example, Dayansagar College buying a piece of land for 11 crore, which is worth of only 10 crore. I will write 11 crore. In second case, 10 crore worth of land, I am buying it for 9 crore. I have to write 9 crore in the books. Okay. Don't worry about the market value. Worry about the deal, at what price you purchased. That's what cost concept. Next, accounting period concept, very simple. You already told about this. We cannot keep on writing the transaction forever. We have to stop. Of course, your semester also, 3 months, okay. Within that, whatever you are learning, you are being assessed, you are being tested, and your mark is awarded. Likewise, business also should be evaluated every now and then. That every now and then is 1 year period of time. 12 months once a business need to be assessed. What is your performance? That is what accounting period. In India, we follow 1st April to 31st March of next year. 1st April of the current year to 31st March of next year. 12 months are called as one accounting period. Some other companies may also have 1st January to 31st December. Calendar year can be their accounting year. But many of the business will follow the fiscal year, the financial year as their accounting year. Somebody raising hand? I saw somebody. Yes. Anything else? No. So legal aspect concept. I request the particular person to mute yourself. Okay. So legal aspect concept means we can record only those transactions which are legally permitted. We cannot just write, I have given 20,000 rupees bribe to so and so. I can't write it. Legal aspect. Okay. That's why you might be seeing these diaries are found in many of the places, right? They will just give a news in the newspaper or TV. 2 diaries were snatched from somebody or taken from somebody, businessman. They will write this much money has given to this many people, or this bribe, or this kind of minister, something. So that cannot be recorded in the books of accounts normally. So legal aspect concept. Matching concept we discussed in the beginning. Income is being matched with the expenditure to find out the profit of the business. To find out the profit of the business. Realization concept. Are you able to see that realization concept? Realization concept.
Yes, sir.
Yeah. Realization concept means you have to record the income or expenditure, or mainly income, whenever it is possible to realize. You cannot go with imaginary. Let me go to mute all. Then I'll mute all.
Sir, I
So can
think,
you mute?
yeah, I think the host can mute everyone,
That's what I'm
and
trying.
once
That's what
they'll
I'm
raise
trying.
the hand, you can unmute the person. Yeah.
Yeah. I think it is now fine. No. So, possible realizable income should be recorded, not the imaginary. You cannot just assume I may get this much of sales tomorrow, so I will write as a sales in my books of accounts to recognize as a income. No, it's not possible. Whenever it is possible to realize an income, you have to write it, otherwise no. Okay. The last one, objective evidence concept, is very, very important concept of accounting. Okay. Every transaction, what you are recording in the books of accounts, need to be supported by some objective evidence. You know the meaning of objective evidence. Suppose you wrote software purchased for 1 lakh rupee. Anand is an accountant. He is simply writing it and taking that 1 lakh rupee. Possible. To avoid that, what's a cashier and accountant both are having a relationship, I mean having a partnership in doing this kind of fraud. Possible, they can do it. Misappropriation of cash is possible. Without buying a software, they can just write it and take the money. Okay. We have to have a control on that also. Of course, the control system is there in a business organization based on the rules and regulations what they have. Okay, sanctioning of the amount. It's not just to go to a cashier and give the bill and take 1 lakh. No, not possible. No company will have that kind of practice. Okay, there will be a process. Okay, there the invoice should go, who is checking the delivery and who is giving the approval and who is finally signing in the check and how the money is delivered. Of course, all are there. But those days, when these kind of systems were not there, we followed a system called objective evidence. Even today it is still followed. Each and every transaction should be supported by some document. Suppose Anand is telling 1 lakh rupee, there was a purchase of software. Originally, it starts from sourcing of the vendor. Every company will have a vendor list, possible vendor list. You might have written a letter to them, mail to them. Sir, we need a software of this nature. Can you supply? Then they will give a quotation. Yes, we are able to supply. This is the feature. This is the rate. You might have received from 4 or 5 people. Finally, you are giving an order to one particular vendor. From that vendor, you are buying. When you are buying, you are getting an invoice from that company. Details of the software and the price and everything will be there. Invoice. That invoice is acting as objective evidence. Based on that invoice, the accountant can record that transaction. Without that invoice, accountant cannot write 1 lakh rupee. Then later on in auditing, the auditor will ask, where is the document for this 1 lakh? If he is not able to produce, then he is held responsible for that 1 lakh. It will be called as misappropriation of cash, fraud. Okay. So to avoid that, we follow a concept called objective evidence concept. Each and every transaction or entry which is found in the books of accounts need to be supported by a documentary evidence. Okay. Suppose you are just giving some 2,000 rupees as a coolie, porter charges. The porter is coming and porting something, you are giving 2,000 rupees as wage. He does not give you any bill. He will not give any receipt for that. For that purpose, you have to make one receipt and keep it with you. You have to get a signature from him in that receipt. Automatic words will be there, pre-printed. Dash rupees received towards dash by so and so. He may be signing that. So you'll have to fill cleaning charges 2,000 rupees. The person signed. That acts as a evidence. of that particular entry. Without that, we cannot write any entry in the books of accounts. Okay. So these are all the various concepts of accounting. We do have some conventions. Okay, some assumptions. Okay. Convention of disclosure. What is convention of disclosure? As an accountant, I should just disclose all the possible material facts.
Professor, you went on a mute.
Cannot hear. No.
Yeah, I'm audible now?
No, now you're audible, yes.
Yeah.
Yes.
The first one, convention of disclosure. We have to disclose all the significant fact, material fact to the audience. We should not hide anything. Okay. Then convention of materiality. It's also relevant to disclosure. What to be disclosed? That's called materiality. Materiality means any significant fact. Hiding of that fact or disclosing of that fact or knowing or unknowing of that fact will change the decision of the audience. Who are the audience? Customer, government, or the tax authority, or owner, or manager, anybody like that. So, knowing of what, unknowing of what is going to change my decision making. That what refers to the material fact. Okay. Suppose there is a case pending against the company. There is a case claiming a compensation by a competitor or by a workman. It need to be disclosed in the bottom of the accounting statement. 1 lakh compensation was asked by a petitioner in the court of law. The case is pending. In future, you may be getting in your favor the judgment, or you may be getting to pay 1 lakh rupee. We don't know, but it need to be disclosed not in the statement, but in the footnote. But in the after the statement, you have to mention about that, so that the users of accounting information will know about the complete information. Next one, consistency. Consistency is very important convention. That means you as an accountant should have some kind of consistency in the principle. You have all liberty to change within the law. You can change your principle, you can change your method, you can change your logic within the law, within the framework. But even while doing so, you should not do it very often without any valid or any logical reason. You should continue doing what you are doing, what you are following. Simple example, those who know accounting may be understanding more better. Depreciation. Depreciation means the value of asset minus from the income of the current year to know the profit. Suppose you are buying a machine worth rupees 5 lakh. You can't just add this as an expenditure to minus from your income to find out your profit. I hope you are understanding. Profit is equal to income minus expenditure. You bought a machine for 5 lakhs. If you consider this 5 lakh as an expenditure, if you add that expenditure to your total expenditure, automatically your profit is going to be less. This 5 lakh worth of machine is not used in this one particular year. It is going to be used for many more years. Suppose the effective use of this machine is for 5 years, then current year use of this machine should be 1 lakh rupee only to be added in the expenditure. That is what we technically call it as, that 1 lakh is called as depreciation. Okay. To find out the depreciation, we have a lot of methods. Suppose today I follow method A, next year I follow method B, last year I followed method C. That gives a confusion to the audience, confusion to the users of the accounting information. So I should not do that. I have to follow, yes, I have to analyze, I have to consider all the methods, and I have to choose a best method in the first year itself. And I have to follow that for some number of years. Unless otherwise there is a demand from law or from any accounting point of view that need to be changed, I can change it. Otherwise, I should not change. I have to follow certain methods what I have been following for a number of years. That is what convention of consistency. You know, consistency, continuity. Last one, conservatism. Convention of conservatism. This is very, very important convention in accounting. Very, very important. Conservatism. What is conservatism? In general, conservatism means in literary meaning.
Saving something.
Conservative.
Very conservative means very not open and
not open. Traditional.
Yes.
Traditional.
Archaic.
He will always
Not ready to change the.
not ready to change. Okay, that analysis societal meaning not ready to change. Yes, yeah, conservative is very conservative, sir. He will not change it very often, very easily. He won't change it. Same logic with a slight change. Slight change. We cannot be more modern in recognizing the income. We cannot change in recognizing the income, but we have to be always conservative in recognizing the expenditure. What I mean like this? What I mean? Suppose you expect there is going to be a loss in the next month. So you have to prepare for that in the current month itself in accounting. Okay. Foreseeing the losses and prepare for that in accounts. Okay. At the same time, don't foresee the expenditure. Sorry, don't foresee the income. Don't prepare for that. What I mean, don't prepare for that. Don't recognize that income which is going to be there in the next month, in the current month itself. Don't give a rosy picture about next month in the current month itself. But at the same time, be conservative. Give the picture about the loss which may or may not arise in the future. Right now, we keep informed about your loss which may occur in the future by creating a provision. Because of something happening in the current month, that is going to be really a loss in the next month. See, simple example. I have sold goods on credit. What I mean by on credit, without getting money, I have given the goods. They will give me the money later. That's what credit sales. Engineers understand credit sales. Okay. Now, my experience says that out of 100 rupees of sales of credit, I will receive only 95 rupees. 5 rupees is not to be received. That's what my experience says. So right now, immediately you create a provision for bad debts. What is bad debt? The debt which cannot be recovered. 100 rupees we sold, that becomes a debt for you. Debt. The person who taken goods from you on credit is called debtor. The money collected to be collected from him is called debt. Debt. Okay. If he is giving, it's a good debt. Good debt. Good debt. If he is not giving, it's a bad debt. But you don't know. He already promised he will give next month. But your past experience, he means it's not only one person. The collective, all the customers. Total receivables are 100 crores. Out of 100 crores, your past experience says that 5 crores you may not be receiving it in the future. They just vanish, or they just have some reason not to pay. So that is foreseeable loss. Record that loss. Record that foreseeable loss as provision for bad debts. Provision for bad debts. That is what we call it as conservatism. Be conservative. Don't foresee the gain, but foresee the losses. Okay. Here an example I given you. Closing stock. What is closing stock? The stock of material which is available in the company at the last date of the accounting year. Unsold goods. If it's a trading company, unsold goods. The value of the closing stock need to be arrived to find out the profit. I might have purchased the stock for 100 rupees per unit, but today it is purchasable in the market for 120 rupees. Because of inflation, 20 rupees is increased. Now, you have 20 units remaining. 20 into 100 you have to take, or 20 into 120 you have to take. Question arises. According to the convention of conservatism, you have to take, anybody answer? Cost is 100 rupee, but the today's price in the market is 120 rupee.
Into 100, sir.
Into 100. Why? I am not foreseeing the profit. I don't know. Tomorrow, how much price I can sell, I don't know. It may be 120 or 130 or 110.
It can even be 90
I
also.
purchased for 100. But suppose today's market price is 90. Then what price you have to consider? You bought it for
90.
No, I still have to consider 100 only.
No.
No, you have to foresee the loss.
90.
So 90.
90. When you buy, you record 100. That's cost concept. You already recorded. And you have been doing a business for months. At the end of the last day of the financial year, you have left with some stock. You have to find out the value of that stock. You know the purchasing price of the stock. That's 100. That's 100 per unit. But today, it can be sold in the market only for 90. Still, if you recognize at 100, you are overestimating the profit.
This
You are
goes to
overpaying the
unused
profit.
products only.
Sorry?
Unused products only counted, right? Like that, because something which we are using for a year continuously, that is counted in the initial cost only, right?
No, I'm not getting you.
Like you said, right? Like something which is not used.
Not used means not. I'm not telling not usable. See, you have been doing the business. On a particular day, you are going to take the stock of the things. I mean, you are going to find out the performance of the business. On that particular day, some materials are unused or not sold.
Not sold.
You are a trading company. You are a trading company. You bought some 100 notebooks. You sold 80 notebooks. 20 notebooks are left with you. It does not mean that you are not able to sell. Sale is going on. Okay. No customer will know when the profit loss account is prepared. But accountant knows 31st March, the profit loss account is prepared. On 31st March, there are 20 notebooks unsold. Now, I want to know what is the rate I have to assign for that notebooks to find out the profit or loss. You know very well that notebooks were purchased for 100 rupees. But today that notebook is saleable in the market only for 90. So you have to recognize 20 into 90. The value of the stock should be 20 into 90.
Is it only for reselling it is considered, or like in my company as when we are taking that antivirus example, right? So we have purchased.
No. We are taking two different things together. The antivirus software is an asset that won't be revalued like this.
Okay.
Closing stock is a current asset that will be revalued like this. Value of the stock. Value of the stock means what I refer stock. Any raw material, any work in progress, any finished goods which are kept in the business for the purpose of converting it or selling it. But software, what you buy and keep it in the company is not for selling. That is for your own use. We will not value that software every year. Valuation of software is nothing but depreciation. Just now I told you, machine case. A machine purchased for 5 lakhs and used for 1 year. The 1 year usage is 1 lakh. In that way, you have to value the software. The software will have a lifetime. Suppose it's having 2 years license, 2 years. You are buying it for 1 lakh. Then 50,000 rupees is the current use. It should be taken as an expenditure. Remaining 50,000 rupees is the worth of the software, which is an asset for the company, which is to be taken in the financial position of the company. Okay. That time you should not worry about the market price of the software.
Sir, regarding the depreciation, if the machine is still in good condition after 5 years,
let it be good condition, no problem.
So how do we account that? How do we account that in the accounts?
We do not know. Today we do not know. Will it be in good condition after 5 years? We do not know.
No. I'm saying we completed 5 years, suppose, and the machine is.
No. Wait. You are not completing 5 years just like 5 seconds in classroom. You have to wait for 5 and 365 days. No, today itself, first day I am buying. I have to decide how much I am going to charge from that 5 lakh as my expenditure of every year. Okay, so I will get the information from the vendor of the machine. What is the effective use of this machine? Then the vendor will tell me, sir, this machine can be economically, effectively used for 5 years, or it can be a number of hours. Okay, we can't simply say 5 years. One company will have 1,000 hours in a year. Another company will have only 200 hours in a year. So
yeah,
we go
I agree. Suppose if it is for 5 years.
Let me just complete. Okay, so we determine the useful life of the machine. We divide the cost of the machine by the useful number of hours or number of years of the machine. The resultant amount is the
depreciation.
Spending of that machine on that particular year. The value of spending on the machine for that year. Suppose Suppose you bought the machine for 5 lakhs. You came to know it is for 5 years. After 5 years, according to you, the machine value should be 0, right? Every year 1 lakh is reduced. End of the 5th year, the machine value in the book should be 0.
Right.
But you are finding a good buyer for that machine. There are people in India who buys second-hand machine from the reputed companies. They will use it for another 5-10 years.
Right.
That's a usage. That's a custom of the second and third civilized countries in the world. Okay, even we buy machine from Germany, used machine. They just scrap it, we buy it and use it in our mainstream of the production. Okay, there are people, they buy it. That time, you just take that money and recognize that money as your income, that's all. But we do not know at what rate we are going to sell it after 5 years. Suppose if you predict, that's also possible to predict, no? If you predict the machine after 5 years can be sold in the market for 1 lakh, assume. There's a prediction. 1 lakh rupee it can be sold. Now your depreciation will become 5 lakhs minus 1 lakh divided by 5 years.
Okay.
Are you getting my point?
Sir, no, my point was, I understand. After 5 years, I am not selling that particular equipment. I still keep that equipment with me. How do we account this equipment value? Because as per the depreciation concept, the account
it becomes 0.
Zero.
Yeah.
But then if the machine is running well and still in good condition, how do we account that? Is my question.
It is rarest event. See, it's not like just you all in the companies. Anybody from manufacturing companies here? See, normally when you buy the machine or plant, it's not just easy. It's not just joining a course or just like buying some or going and taking some dinner in some hotel. It's like a very big process. Very big process. It's committing crores and crores of money. So nobody will go just that ease, which will have a value in the end of the 5 years. Definitely in the beginning itself, we will decide the useful years of the life. I mean, useful years of the machine, of any other asset. Still it is usable. Still it is usable. It can be usable, but the output cannot be received as it was in the 5 years. So you have to definitely sell it. Suppose your business decides not to sell it. That's what your question, hypothetically. Suppose your business does not want to sell it.
Right, sir.
We have to revalue that asset. And we have to appreciation will come. The 0 is the book value. Okay. So we have to revalue that. Suppose the asset value is suppose 2.5 lakhs. 2.5 lakhs. Then you have to revalue the asset. It goes to the owner. I mean, the entry is like this: machine account debit to profit and loss account. Okay. You consider that as a income.
Right.
You are not buying from anybody. Right. It is automatically coming to you because it is there with you. You are not discarding it. You are not selling it. You are using it further. Like that. But it's a rarest event. But we do have possibility for that.
Right, sir. Right, sir. Thank you.
Yes. But normally, what will happen in general? Anybody can tell me if you are there in a manufacturing company. They will sell before the effective life of the machine, because technology keeps on changing. 5 years may be a small, less number of period, but in general, if you buy a plant, if you buy a machine, it can be for 10 years, 20 years, 30 years. In that case, after 10 years, you definitely feel that this technology is outdated, or there is a upgradation has come. You will try to upgrade it. Okay,
sir, what happens is basically there is something called maintenance for this plant. So the maintenance cost goes beyond the depreciation. Then I think it's better to upgrade it and just sell the old.
Yes, you are right. Excellent, correct. This is what we call it as revenue expenditure and capital expenditure.
Yes.
Normally, if normal average day-to-day maintenance is considered as an expense, it need to be minus from income to find out the profit.
Right.
Suppose the maintenance charge is more and it adds the income earning capacity of the particular asset, then it need to be capitalized. It should not be minused from the income. It should be added with the machine cost itself.
Right, sir. Right, sir.
Yeah.
Thank you.
Okay, so these are the various concepts and conventions which need to be followed while preparing financial statements. GAAP, GAAP, whatever we discussed so far, okay, put together in one particular country, what and all need to be followed. That is called a generally accepted accounting principles. A set of framework, a set of standard, or a set of guidelines which is to be followed in recognizing the financial transactions, recording financial transactions, finding out the result of financial transactions are called as GAAP. So each and every country was having a GAAP. Indian GAAP, US GAAP, Singapore GAAP, like that it was there. Generally accepted accounting principle of a particular country. So far what we discussed is in general, the discipline, the accounting as a subject is having this many. Okay. Each and every country can notify what and all they follow. Okay. But today we are living in a globalized world. Okay. The investor in India can invest in the Singapore company. The investor in Pakistan can invest in US company. So I want to analyze the financial statement of a company which I want to invest in, which is there in USA or which is there in Singapore. My accounting principle, what I follow in India may be different from the accounting GAAP. Please understand, the broad concept remains the same. Accounting principles and the conventions, concept and convention. More than that or altering to that, the country may have some altered GAAP. Okay, so Singapore GAAP is different from Indian GAAP. So I get a confusion between a company which is having its books of accounts under Indian GAAP and another company which is having a books of accounts in Singapore GAAP. So comparison becomes illogical. Same cement company which is in India, which is in Singapore. Both companies I want to compare. The rules and regulations, the accounting framework, what they followed are different from each other, then definitely that comparison is illogical. I can't compare. If I compare and take a decision, that cannot be a good decision. So to avoid these kind of difficulties, people have evolved a system called international financial reporting standards. So please understand, basically the subject itself, the accounting itself is having its own concepts and conventions. Based on that, countries develop its own GAAP, generally accepted accounting principles. If each and every country has gaps, then there is a logical comparison problem arises. To avoid that, to have a uniformity throughout the world. Before I continue, I just tell one more incident. See, before this IFRS was introduced, each and every country has to prepare 2 times a financial statement. One is according to their own GAAP, another one is according to US GAAP. If it is an international company working in India, functioning in India, it should publish its financial statement according to Indian GAAP to India, in India. And it should convert its accounting statement into US GAAP if it wants to publish it in the global level. This was a difficulty. Now, except US, many other countries have joined together and evolved a concept called IFRS to have a uniformity throughout the world, except US. Okay, so those standards issued by IFRS Foundation and the International Accounting Standard Board is called as IFRS. What is IFRS? International Financial Reporting Standard. International Financial Reporting Standard. IFRS means International Financial Reporting Standard. It is a uniformity of accounting principles. If you are a member of this foundation, then we have to follow this. India is a member of this foundation. We follow this. But we don't follow just what they told. We don't just follow what they told. We don't just copy. What we do in India is we just take that and converge with our own requirement and we have it. So that is called IND-AS. IND-AS. IND-AS means Indian Accounting Standard. The converged form of IFRS is called as IND-AS. You remember in the second module, I was telling about this while telling about the introduction. Second module. Look at this accounting standard. So this chapter is given as self-study. I repeat again. Accounting standards are nothing but the standards issued by the professional accounting bodies of a country. In India, we have an accounting body called Institute of Chartered Accountant of India, one which is conducting CA examination. You know, that organization, they will issue the accounting standards based on the gap of that particular country. Okay. Likewise, each and every country will have their own accounting standards. That also creates a problem because each and every country has its own standards. Comparison of one country's accounting statement with another country's accounting statement becomes illogical. To avoid that, we are going with IFRS. So Indian converged form of IFRS is IND-AS. Look at this, IND-AS, IND-AS, Indian Accounting Standard. Okay, based on IFRS and our own gap and our own accounting standards. If there is any much difference in the IFRS of any particular concept, we don't follow that as it is. We just modify that. The modified version of IFRS, which can be used in India, is called as IND-AS. It is almost near to the global IFRS, but it's not prepared separately, or it is not created separately. It's also based on IFRS. So before preparing IFRS, that board, IFRS Foundation, was expecting the representation from all the member countries. All the member countries have given their own opinion, what they have been following. That is being incorporated in IFRS. Okay, point 1, point 2, point 3, like that, IFRS are there. Okay, so IND-AS. So please, this is an assignment for you. This is an assignment actually. You have to, I sent out a document. Based on that, you have to prepare some theoretical note on this accounting standard. I'll explain that a little later through a document, through your LMS. Okay, so as of now, you understand IND-AS, IFRS, GAAP, and accounting standard. Okay. Any doubt in this? Any doubt in this?
Sir, will any global entity accept our system, Indianized system in this?
Sorry.
Our whatever that Indianized accounting system you're talking about.
I'm very sorry. Come again.
The Indian accounting system. What?
Indian accounting system. Can you type in at least? Otherwise.
Sir, actually, he is asking whatever our Indian accounting standards are there, will globally it is accepted?
No. The IND-AS, see, it's not like accepting or rejecting.
Yeah, it's only preparation.
Actually, the purpose of it is only to compare. Suppose you are an investor, you are looking for an investment in a pharmaceutical company. Okay. Suppose you are in Singapore, you are having money, some 10 crore you are having. You take an example of Warren Buffett or any other investment company. They look for global investments. Okay. Of course, strategy of investment is different. Suppose you decide to put your money in, park your money in pharmaceutical companies. You want to buy the shares of pharmaceutical company. Now we have an array of pharma companies in the world. Okay. You are comparing which company is better. While doing that comparison, if it is in IND-AS, it's okay to compare. Another Singapore company, it also will be in Singapore, Singapore accounting standard, or it should be in IFRS. Many of the countries are just blindly following IFRS. So that is just on par with IFRS, or just it's IFRS. But IND-AS is slightly modified for Indian version of IFRS, but it's closely to IFRS only. So it's not a concept of accepting or rejecting. It's a comparison. So you are in Singapore, you can compare Indian pharma company with European pharma company, because both are having a same accounting principle. It is having IND-AS, they are having IFRS. You can just compare. The comparison becomes easy. But nobody is there to accept or reject. No authority is there to accept or reject.
So basically, sir, you want to say that by keeping the base as a IFRS, every country if the country need, they could make their own,
yes,
or either they could follow the
change it. Yeah. But at the same time, the change should not be more, because if you change everything, then that becomes your own accounting standard.
Okay, so it's just
Then there is
basically
no need of IFRS.
the base is always IFRS, and you could change a little bit enhance on top of that.
Correct. The logic is to bring in uniformity over a period of time. Definitely, even IFRS also getting changed based on the request of member countries. Since one country is following and it is thinking that that is superior, that cannot be imposed on other countries. So based on the meetings, based on the deliberations, they find out a commonality.
The India is making.
Your voice is breaking.
Basically, sir, if India is making their own, that is it's going to be get an. If the India is creating their own, is it should be approved by
I'm really
IFRS?
sorry, your voice is breaking. Anybody can tell me the same thing if you listen properly.
Hello, I'm audible.
Yeah, yes, you are. Yes, you are.
If someone is making their own reporting standard, it should be approved by IFRS or not?
No. See, each and every country will have its own accounting body. That body only makes accounting standard for that country. Okay. If you make an accounting standard for your own, and you can do so. But for the global acceptance, it's not a legal acceptance. The global acceptance, what I mean, the global investors who invest in your company should believe the accounting standards what you are following. For that purpose, you are just coming to the on board with the IFRS, or you just follow IFRS. That's it. No global accounting body to approve or accept our own accounting standards.
Sir, one more doubt is there.
Yeah.
Who is going to verify whether a company is following accounting standard or not? If any particular company who is exporting or importing from outside country, whether that company, whether it is following proper accounting standards or not, who is going to verify, sir?
No. See, actually, good question. Not only a company which is having a global presence or global dealing should follow Ind AS or IFRS. There is no such logic. Even a company which is in India, not even doing a business with outside, not even having a branch in outside India, should also follow Ind AS according to Indian accounting body. Ind AS should be followed. Okay. Who is going to monitor? Nobody is going to monitor, but it is getting automatically monitored like this. If you are a public limited company, can you recollect the question? One of your classmates was asking, private limited and public limited. I was telling HDFC Limited is a public limited company. What is the basic feature of public limited company? The share of that company can be bought and sold by anybody else without the knowledge of other shareholders. Okay, that means for doing so, it should have some place where you can buy the share of a company. Anyone can tell me where you can buy the share of a company?
In stock exchange.
Stock exchange.
Stock market.
Yeah, stock exchanges through stock brokers. So we have NSE and BSE, two famous and only two existing stock exchanges in India, NSE and BSE. So if you are allowing your members, member means shareholders, if you are allowing your members to buy and sell the shares on their own through from your company or from your existing investors, you should have arranged that some platform. That platform is stock exchange. You cannot just go and buy the share of any company in the stock exchange. Before that, the company should have approached the stock exchange and get their shares listed in the stock exchange. They should have got permission from the stock exchange that stating that any people coming to your stock exchange in need of buying my shares from anybody else who is having the share, you should allow, please. That agreement should be there between the stock exchange and the company. That is called listing agreement. Listing agreement. Company will not sell. Company will sell only one time. The beginning. That is called initial public offering. Fresh issue. Okay. Some time back, SBI card has come out with an issue. That time, company directly sells the shares. This is what between the shareholders, between one who is having a share, one who is intending to buy the share. So to facilitate that purchase and the sale of shares, listing is done. While doing a listing in a stock exchange, stock exchange will have all these rules and regulations. You have to every year file your financial statement with the stock exchange. They will check it. Okay. And then before you file your financial statement to a stock exchange where your company was listed, where your company is listed, the statement of accounts will be signed by a competent auditor. In India, we call them as auditor. In US, they will call it as public accountants. CPA, you might have heard about it. Certified Public Accountants is in US term. In India, the counterpart of them is called as auditor. We generally call them as auditor. CA, Chartered Accountant. Proper word is Chartered Accountant. The Chartered Accountant should sign that statement. The Chartered Accountant, by rule, the code of conduct is there for him. So he himself has to confirm that the companies have followed Ind AS in India. Or is there any change for that particular company, for that particular sector? That should be followed. Okay. So the auditor or the chartered accountant is the one who is ensuring this.
Okay.
How we can ensure? How can we believe that he is ensuring or not? His moral code of conduct, his way of doing that profession is there. So he will ensure that. So based on that, you are submitting the report to the SEBI, Securities and Exchange Board of India, as well as to the stock exchanges. From that, it is ensured that you have followed your accounting principle. But no company will be dared to do this kind of blunder mistake of not committing or not following this kind of Ind AS. The software itself nowadays, the software itself is tuned to the accounting standards. I told you ERPs, okay, Tally or any other ERPs, okay, is tuned to these accounting standards. So no need of checking, it's automatically checked. The watchdog is the auditor.
Okay, sir. Thank you.
Anything else? I think we have come to the end of this today's session. Since we have afternoon also the class, we cannot prolong for even 10 minutes. I just explain some terminologies for 5 minutes. Okay. And I ask you to come prepared for these terminologies next class. Okay. Transactions, we already discussed. Okay. Capital, the amount invested in the business by the owner is called owned capital or just capital. If it is a company form of business organization, it is called share capital. Many people are contributing money, more than one owner, not a partnership firm, but a registered company, limited liability company. Then liabilities, we discussed, liability means any value payable to others by the business. Assets, any resource owned by the business. Equity or net worth. Asset minus external liability is called as net worth or equity. Asset, total asset, minus external liability. What is external liability? Amount payable to others except owners. Amount payable by the business to outsiders except the businessman is called as equity. Or you can say the book value of owner's claim in the business is called equity or net worth. The total amount, the total asset is 1 crore. Bank loan is 50 lakhs. That means 50 lakhs is contributed by the owner. So the net worth is 50 lakhs in that example. Okay. So equity or net worth is nothing but the net worth of the business, book value of the owner's claim in the business. In equation form, total assets minus external liabilities. External liability on a given point in time is called the equity or net worth. Okay. Or you can say capital employed. You can call them as capital employed. Okay. The next one, capital expenditure. Capital expenditure, you know, expenditure, spending. Spending is called expenditure. Capital expenditure means buying anything which is going to be used in the business for some number of years is called capital expenditure. Buying that software, buying a machine, buying a piece of land, buying a computer is all capital expenditure. Simple example I'll tell you. A computer trader, PC trader, if he buys computer, It's a revenue expenditure. Okay. A bookstore is buying a computer, is capital expenditure. Can you make a difference? Bookstore is buying a computer to keep the books of accounts in the computer. So computer is going to be used by that bookstall for many years. So it's a capital expenditure. It's a fixed asset, capital expenditure. Okay. Another company, the nature of the business itself is buying and selling the computers, dealing with computers. If that company buys computer by spending some 50,000 rupees, that 50,000 rupees is an expenditure, no doubt about it. But the 50,000 rupees is a revenue expenditure. Revenue expenditure means a day-to-day routine recurring expenditure is called revenue expenditure. Another example for revenue expenditure is payment of salary. Payment of rent is a revenue expenditure. Buying of a building is capital expenditure. I hope you are getting it. Next, there are many. We'll discuss one by one little later. Okay, I don't want to take much of your time. You also have class at 1:30, right?
Yes, sir.
Yes.
So, 2 minutes. One assignment. I'll give a write up and I'll post it in your LMS. You can refer that. But I just want to tell you orally also. The second module is fully self-study. That becomes one of your first assignments. Okay, what is this? You have to prepare an essay.
Not audible, sir.
Yes, sir. Regarding, sir.
The essay regarding the accounting standard it will be. Yeah.
Sir, you are mute, I think.
Yeah, I think he left.
He got disconnected.
Yeah, he got disconnected.
I think he's going to send, right? Yeah, he's going to post from the LMS.
Yeah,
right?
LMS.
Yes, anyway, all the assignment will be posted or emailed.
Okay, the exit.
Yeah, we can exit.
Yeah, let's join on 1:30. Yeah.
Okay. Bye.
Okay, thank you. Bye.
Thank you.
Bye.
So it's on the same link. We need to join again at 1:30, right?
Yeah,
I think so.
Same
For
link.
the whole
Yeah.
trimester,
Same one.
Discord link.